You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Thank you for joining us on Minds of Commercial Real Estate. Today we have Mark Silver, CIO, founder of Sunday Capital. Mark, thank you for being on the show.
Thanks for having me. I'm excited.
All right.
We're in front of a very colorful table.
Thank you. So Mark, you are, do a lot of deals on both spectrums of the table as an owner of a multifamily and on the other side as, lending. And what do you see out there today?
It's a great question. And I've always thought that I didn't have the whole picture. And so it's been really interesting going from, our story was always that we started as equity buyers. And then we started a large brokerage firm out in New York City where we were doing about 5,000 to 10,000 apartment leases a year. And we always wanted to get back on the principal side. But now that we're on the lending side, I feel like we have the full picture of what's happening. And it's really exciting. It's like really interesting what's happening. I find the market today to be so difficult in so many ways. And it's really stalled our equity business in a lot of ways. It's just hard to finance anything. And on our lending side, there's just so much flow that of people that used to go to these regional banks that it's really created this really interesting opportunity that we're seeing today, which is exciting.
All right.
Yeah.
As a owner of a multifamily, how did you get started in that in Southern California?
It's a little bit of a crazy story. It started with a phone call from a friend. When I was very young, we started buying in New York City haphazardly. I don't know why we did it, how we did it. Somehow we did it. One of the things I like to say in real estate is you just got to go try it. And so I think we definitely just tried to go try it. We tried it. We actually tried it a lot of times, like close to 100 times in New York. And we got a call from a friend that said, guys, you guys are doing some crazy stuff in New York. Come to California. I think you'll find a little bit things that are easier, which may be a little contradictory to what people think about California. And you should bring your New York attitude and come out to California. And initially, we all looked at each other, and one of my partners was actually leading the charge. And I was like, that's crazy. We're so far away. We're New Yorkers. We're doing this. What do we know about California? And I started digging into it a little bit, and things started popping up that I said, this is interesting. And like one of the major things for us in California is that there's this regulation called Prop 13. And for your guests that don't know that, Prop 13 is basically allows you to keep your taxes set upon your purchase price. And one of the things we hated about New York is that they reassess your taxes based on your gross income every year. And what we're finding in New York compared to California is that we would do all this work, taxes would eat away at anything we just did. And so when we were in California and we saw this, we said, man, this is such a breath of fresh air. And then we started thinking of other things, and we realized there wasn't a lot of institutions doing what we were doing. And so we came to California. And I remember specifically we were doing a deal on the Lower East Side of Manhattan, and we were doing a deal in LA, our first deal. And the only reason we bought the deal is because it was right next to Netflix headquarters. And it was easier to do the deal from sitting in New York, the LA deal, compared to the New York deal. And the New York deal was literally a minute away. And that was like our epiphany, like something's wrong here. And so that's kind of our story on why we moved. California has been really interesting, and I think we've taken advantage of it. I think it's a harder environment than it has been when we initially came to the market in 2016, but there's definitely differences.
On your, building sides, how is it dealing with the tenants, with the new laws and everything after COVID, not paying rent?
It was hard. We're running a business like everyone else. And in COVID, it felt like everyone was getting helped. And we felt as at least landlords, we were getting a little punished. And there felt like no end in sight. I think there's parts of being a landlord that there's a lot of expectations put on us. And so it was very difficult when it felt like the only thought process was about the tenants. And we get it. We love our tenants, and we want to make sure our tenants are taken care of. But I think a lot of things that happened during COVID is that it's at the expense of owners. And so it was very difficult when people weren't paying rent, when we couldn't move tenants, where we couldn't raise rents, that there was instances where we couldn't even get into tenants' units because of COVID to fix issues. These are all things that we don't like. We want it to be able that we want to help tenants, we want to fix tenants, we want to be able to do things. And it really stalled out. I would say that until this year, things were broken. Starting earlier this year, maybe a little bit late last year, things really started on thaw. So I think we're back to a normal environment, thank goodness. And I think we're back to at least a environment where there is at least a equal playing field between being a tenant and being an owner. And I think that was really displaced during COVID.
Are you still looking to increase your portfolio?
So we are. One of the things that we've been focused on a lot is trying to find opportunities in this market environment. We're very focused on the debt side, but we're starting to see some things in the market that are interesting. I don't know if distress is the right word. I've been telling my partners at Sunday that we're in a phantom distress market, that everyone thinks, oh, there's distressed everywhere, but you can't really find it. There's lots of reasons behind that. But we're looking at deals all the time. We're seeing a lot of deals start to come to the surface right now for two reasons. One, if you did not extend and pretend, so if you had a debt issue for the last year or two, a lot of people were able to mod out their current loans to give them more time. If you were not able to do that, it is now creating opportunities because there's forced liquidity that needs to happen. The bank has put pressure on you. The GP that's maybe in the deal can't raise capital, so they're starting to just capitulate and sell. We've seen a lot of those opportunities. The second thing is we've seen adjustment in cap rates. So for the last 10 years, in good markets, getting cap rates that were at 3 or 4 was just normal practice. I am starting to see cracks in the market where we're seeing 5, 6, 7 caps, which is really exciting. We used to try to build to that. So we used to buy a 3 cap and try to get to a 5 or 6 cap. Starting there is something that is obviously a lot easier and built to a lot higher cap rate. The one thing that's giving us pause though, and this is a little bit of the longer answer, is that we don't know if those cap rates are real. So even though everything seems to be unthawing, we're seeing some of this distress or some of these opportunities bubble to the surface, we're seeing higher cap rates. One of the things we are concerned about when we look at other deals is like, is that a real cap rate? Are rents real? Is the supply demand, we're hearing this in other markets, and not to pick on, but like Phoenix and Nashville and Charlotte, like there's things happening that you're saying, I'm buying a 6 cap, but maybe I'm actually still just buying a 4 cap. But things are happening, and we're looking mostly outside of California right now at those opportunities.
Let's switch gears to your debt side. People coming to you for lending on different, portfolios, different sectors. Which sector are you seeing the most right now?
Good question. So the number one thing we are seeing right now is when people are buying in this market, because volumes are down, everyone's seeing like the transaction volume in CRE is down majorly year over year, and it continues to be, and a lot of it is increased rates, is we're seeing people that are doing very more complex business plans. And so a lot of things we're seeing right now are business plans that I didn't even see a couple of years ago. Like one big business plan we see is conversions. And so like a real popular business plan that we're getting sent to us at Sunday is a hotel conversion business plan. And this is where people are taking old motels or hotels across the United States, which were not working or weren't maybe like starting to be in the default territory. They can pick it up at a very low cost per door, which is a big arbitrage between what you can build it and what the old vintage product is selling for. And then they can do an easy conversion into a multifamily product and be able to charge rents that are significantly lower than the old vintage and the new product. We're seeing that business plan 10, 15 times a week. That was something I didn't even know about 2 years ago. So you're starting to see people say, how do I build yield? How do I take advantage of this market and get to a higher cap rate at a quicker pace than building something or even taking the old vintage? We're also seeing a lot of what I was saying in this distressed market, people capitulating. So these banks, they're forcing people to sell, GPs losing equity, or actually foreclosures. Right. And so a lot of a business we're seeing more recently is actually that happening, these foreclosures happening, and the new sponsor coming in, and we're giving them a loan to actually finish the business plan at that reset basis. The third thing I'd say that is really popular right now is affordability. It's like a key word. It's a key word that we see in multifamily. We're focused usually on multifamily. And there's business plans that legitimately are taking market rate multifamily and switching it to affordable market rate or affordable Section 8. So in a lot of places around the market, and I can't believe I'm saying this, you see that Section 8 rents are higher than market rate rents. And that seems like what are you saying? And what's happened over the last couple of years is the way that Section 8 works is that they reset the rent every year. And what they allow you to do is they have a maximal allowable rent. That rent has grown so much that in areas like Nashville, and you see it in California, and Charlotte, and Charleston, I could keep going down the list. If you take a older vintage unit and take it from a market rate to Section 8, the Section 8 is paying well above what you would get for market rate. And so we're seeing a lot of business plans that are going into this affordable space. A, you have the demand, but B, you're getting higher rents.
Actually, we are seeing a lot. I've seen a lot of the ED1s in the city of LA, the 100%, affordable housing for the 55 years, covenants. Are you seeing a lot of those coming for lending on the construction side, on the permanent financing?
So we did our first ED1 loan, which was an interesting loan where someone took a asset that wasn't a affordability play or wasn't affordable housing. They were able to get over-the-counter permits within 60 days and convert that asset from its current use to affordable housing, and are going to do a business plan based on exactly what I just said, this Section 8 play. It was really fascinating doing the loan because if ED1 did not exist, and for your viewers that don't know what ED1 is the new initiative that Mayor Karen Bass in the city of LA put in to deal with two things. One of the big things in California is it takes a long time to get through permits, sometimes 5, 7, 10 years. So she was trying to expedite that, which is really good for us because we need more housing. And the purpose was that you could do things within 60 days over the counter. And the second thing is they removed a lot of the zoning regulation or the things that you have to get through in a permit to actually get something approved. Like think about parking. Like don't have the right parking. So even if you got through the permit process, the zoning restrictions that exist, you'll never get through it. She removed that. And so it's been interesting to see actually in real life examples, we lending on it and it actually work in real time. And it's fascinating.
Yeah, those numbers are very unique for 400, 500 square feet more on the new construction. On the conversion, I'm not sure what the square footages are, but like they're doing one bedrooms and 400 square feet.
Yeah. A lot of the affordable stuff that I've been speaking about usually is focused on one bedrooms and studios, and they tend to be smaller. So the deal I was talking about, which was a current use and then got switched to something else, the average unit size in that new one for these affordable units would have been studio units, and they would have been around 250 to 300 square feet, just as a for instance. And then I think you're talking about is you're seeing a lot of builders come out there. Correct. Because one of the issues builders had in LA just specifically is that it took them 5-7 years to get through permits. The zoning restrictions that we were talking about, you had to do subterranean parking and other things. With that lifted, it's a lot cheaper to build these things because you don't have those parking requirements. And they're doing it for what we like to call micro or functional use units, which tend to be a little bit smaller.
If you're looking for a particular deal today, which is easily for you to lend on, what kind of deal would that be today?
Our bread and butter is multifamily. So the things we look at is our ethos is we like to lend on things that we would own and operate on. That's what we say at Sunday. We bought a couple hundred multi-buildings, and so we have a good experience on it. The second thing is we look for big markets that are liquid. So the way we like to say it is we say MSAs, which are metropolitan areas. And we really like to focus on the top 20, top 50 markets. So think of the LAs and San Franciscos and Atlantas and Nashvilles of the world. And then the third thing is it really comes down to sponsor. And so if it's a deal that we like, it's in a market that we can do it in, it really comes down to the business plan and who the sponsor is. And I think we're fortunate enough at Sunday that we have great sponsors and they know what they're doing. They've done usually these business plans 10, 20, 30 times so we have comfort around it. And I think we're aligned. But one thing I know, both from the equity side and the debt side, is that it really matters who you're dealing with. Like, if you can operate something and execute is all the difference in the world. I see a lot of things in the marketplace, and you probably do too, where someone bought the same deal in the same location and you had two different outcomes. And the outcomes difference usually was one operator executed, the other operator didn't. So it's a big thing for us.
Passive versus active.
It's sometimes it's passive versus active. Sometimes it's experience. This operator had this experience, this operator didn't. Right. A lot of things we've seen in the market recently is they had struggle during construction. So, and a lot of that maybe had to do with COVID. Maybe that had to do with cost, inflation rising. But yeah, the more experienced operators have dealt with these things so they can overcome maybe some of the hurdles. The thing about real estate is anything can happen, right? Bad things, good things. You can get lucky, you can't get lucky. And I think we're looking for operators that can roll with those challenges because we know they're coming.
Right. So I've done a lot of SBA deals, 504, 7As in my lifetime. And, back when the prime was at the all-time low of 3.25, getting these SBA 7A deals with margins of 40, we were at, let's say, around 7.25. Today, those same clients are at, 8.5 plus 3.5 at an 11.25 rate. They're getting hurt. Their cash flow has been, their sales are not as high. So, and their leverage is lower. Are you seeing those clients come to you for just get 1% lower or just, help the cash flow?
Yeah, I think it's a really interesting point. And I think one of the things I'd say about that is no one has not been affected by this rate change. And just putting it to our stuff, and let's just go to the multifamily lending. I think we were seeing similar rates getting done all the time. And the best way I can explain it is when our borrowers used to take a loan from Sunday, they would come to us, we would charge, 7 to 8%. And the time for us giving a loan from them takeout was really short. Like we were less than 12 months. And one of the reasons is people were rushing to get this type of leverage. They could fix it at 3-4%, and they wanted to go as quickly as possible to get out of our 7-8% paper. Today, I'm charging more. I'm not charging 7-8%. Wow, we're definitely higher. But my loans are taking a lot longer. And I think one of the things that's happening is they're not rushing to go get paper anymore. And my rate, let's say it's at 10% fixed, doesn't seem that bad anymore. And I think there's a level of understanding with these operators that A, I'm not rushing, B, the rate's pretty good. And secondarily, if I do get a new note today, I'm going to have it at a higher rate. Like I think the best rates I see in the market maybe are 5.5, but most things are getting done between 6 and 7. They're putting prepays on you, as you know. So you have your yield maintenance or that prepay. And then I think there's a real conviction in the market that things are going to get better. And so if they wait with me, then potentially they're going to say, oh, I'm going to in 6 months wake up and say, I'm going to have a better rate. I'm going to get more leverage and it's going to be a better environment, but it's very difficult. Those wild moves are one of the reasons we're seeing a lot of flow. So if you had a construction loan, for instance, that was at prime and it started at 3.25 and now it's at 8.5 to 9 plus all these other things, you're really struggling. It's a big difference in cash flow. So it's a crazy market. It's moved very quickly, but we're seeing a lot of flow from exactly that. We're seeing a lot of changes. And I think we're seeing a lot of change in behavior.
You actually led me to my next question, which is the question that everybody probably asks you every day with what's going on with prime. Is it going to come lower? The expectation beginning of the year, everybody said it's going to decrease by 2, 3, 4 times. Well, now here we are in May, hasn't decreased, and they're saying it's not or it will. It's very hard to predict. What's your thoughts?
I am shocked is the first word that comes out of my mouth. I was shocked by two things, actually. I was shocked on the speed in which they raised rates originally. If you asked me if rates were going to rise, we said absolutely yes. I thought it was going to be a gradual raise. So what they basically did over 12 to 15 months, I thought was going to happen over 3 years. And then secondly, because they moved so quickly, about 12 to 18 months ago, I would have said they would have been cutting by now because they would have to. So this had been a huge surprise. It's really hard to predict because one of the things that has changed in this interest rate environment, especially because of the politics, is that politics are now involved. So the Fed is supposed to be independent. I don't know necessarily they're acting independent anymore. There's a election year, which is actually what's throwing me off. So I don't think the government wants anything to fall apart before the election, and rightfully so. If they don't change rates soon, that may happen. I think conservatively, I don't think anything really happens. There could be a 25 bip move in either direction. I don't think that changes anything. Over the long run, though, if rates do not come down, there is going to be major issues in every asset class, and specifically CRE, because we just can't have elevated rates with the amount of leverage in the system.
All right. Well, thank you, Mark. Appreciate you being on the show.
Yeah, thanks.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.